Okay, I think we can start now. Very warm welcome to our speaker, Ms. Jyoti Bhandari, and very warm greetings to all our attendees and participants who are watching this. This is a wonderful webinar that we are doing, a very special series for Women's Day Special. And as part of this series, we have our first speaker today, Ms. Jyoti Bhandari. I will now request Neha to start the meeting and introduce.
Thank you, Mikla. A very good morning, everyone. GHRDC welcomes you to today's Women's Day special webinar honoring women leaders and visionaries series titled From Savings to Stocks Building Financial Independence at Every Age. Thank you, everyone, for taking our time and joining in with us today. We are very delighted to have with us Ms. Jyoti Bhandari, a woman leader and visionary in the area of wealth management. GHRDC, as many of you would be aware, is a 28 years old education research firm dedicatedly working in the education sector in the area of ranking, training, mentoring, and research with the sole aim of working on upgrading the quality of education in various sectors and benchmarking the best of the educational institutions in our country. Today's discussion will revolve around the topic from savings to stocks, building financial independence at every age. This topic explores how individuals, especially students and young professionals, can move beyond simply setting money aside and begin strategically putting their money to work. We will unpack the mindset shift from the short term saving to long term wealth creation and demystify the world of stocks, compounding, risk management, and diversified investment. No matter your age or income level, financial empowerment is possible with the right knowledge and strategy. We will now invite our distinguished speaker to talk about this very exciting topic. Also, I would request our wonderful attendees to type in any questions if you have in the chat box given. I would request Ms. Aradhna Thangakoti to introduce our eminent speaker for today. Over to you, Aradhna ma'am.
Thank you, Neha. I'll now read out the profile of Ms. Bhandari. Ms. Jyoti Bhandari is a seasoned private banker and wealth management expert with over 2 decades of experience in advisory services. She has managed large investment portfolios for ultra HNIs and family offices, as well as handled global wealth for Indian investors, onshore and offshore portfolios. Jyoti is the founder and CEO of Lova Capital, where she focuses on personalized financial strategies and innovative wealth management solutions. She has held positions of responsibility at top tier multinational and national financial institutions, including BNP Paribas and Edelweiss Global Wealth, and holds degrees from the University of Delhi and IIM Calcutta. In a world of investment and wealth creation, which is mainly male dominated, Ms. Bhandari is a trailblazer and pioneer dedicatedly working in this area as a woman leader. Most welcome to our webinar, Ms. Bhandari. And we have Mekhla Sinha, the Executive Director of GHRDC, who will now be acting as a moderator for the discussion today. With this, I would request Mekhla to now take over and initiate the panel discussion. Over to you, Mekhla.
Thank you, Aradhna. Thank you, Neha. We are very delighted to have Ms. Bhandari today for this very interesting webinar. Usually, we cover topics in our webinars which are related to students, careers and skill sets and education choices, and how should institutions really work on themselves in various parameters. But this was a very interesting series that we came up with, and this is completely dedicated to women leaders, honoring them, their careers, and the kind of impact they've made. And this is an interesting series also because this is a very important topic, not just for women, but for people at every age and at every income. This is one of the most important agendas or purpose or goals that people look at when they are, building a career for themselves. In fact, right from the beginning, when they start their schooling and college education, this is one of their primary goals. So we are going to be talking on a very interesting topic today, and I can't wait to jump into the first question. Before that, I would also like to share that we have a very special set of attendees today, the student community and young professionals who are going to be watching this. So especially from their point of view, this is going to be a very significant webinar because at such a young age, especially, when students are just studying or when they're just getting into their career, they don't really think so much about wealth creation because they've not really started earning. But I'm sure that from today's webinar, that Jyoti will be sharing her insights and her tips, they will get wonderful ideas on how to start right away. So without any further ado, Jyoti, very warm welcome once again. And like I said, we are super excited. This is a very important topic for the well-being of everyone. So you've had a very interesting, career and the kind of background that you've been through. You went through a complete, that picture perfect profile of coming from, wonderful universities and then going into a corporate career and then working at a corporate firm, which is, the dream for most of the students when they come out from colleges. But then you chose this uncharted path for yourself where you took on this whole business of wealth creation, investment, stocks, and started running this company and guiding people. And this is something which, of course, is not so much known in, when it comes to female especially. So we just thought the first question that we like to ask you is, how did you find this path for yourself? What inspired you? What were the influences in your life? How did you really come to this? And what were your greatest takeaways from this?
First of all, thank you, Meghla, for this opportunity, and I'm glad to be here. Thank you, Aradhana and Neha, for a wonderful introduction, and I'm sure we'll have an insightful session, and students will have a lot to take away. I'll do my bit, the best I can do here to share my journey, and I hope I'll be able to touch some lives here. So, yeah, so I started very early in 90s. I completed my business economics from Delhi University and entered into the world of capital markets. They always fascinated me while I was studying, and I had, few neighbors around me were always into, talking about stock markets. My father was investing in, UTI in those days, and we saw the scams. So it always fascinated me. Um, when I grew up, I grew up either to become a doctor or an engineer. I studied sciences, but somewhere I felt that that is not for me. So I chose economics as a field, and I really had to fight it out with my dad for that, So yeah, so over the past 25 years, I've worked across wealth management companies, investment banking, funding, IPOs, cross-border transactions, worked in various different roles in leading Indian as well as financial institutions globally. So when I began, I didn't know exactly where I would end up actually, but what I loved about my role is the dynamism of markets. Even today, there isn't a single dull day, And mostly the people I met, entrepreneurs risking everything, families protecting generational wealth, young professional chasing quick gains, investors paralyzed by fear or greed, so that fascinated me always. And since I was interacting with these people every day, so it was too much learning every day. And when you are in touch with the markets, investing or advising them or talking to them, you're in touch with the whole world. You're learning every day. You're evolving as a person as well. But what I noticed as a pattern was people don't lose money because they lack knowledge or they're not aware. Especially in today's age where information is available, everything now, from YouTube to ChatGPT, we know everything. So they lose money because they lack emotional discipline. It's the behavior. So the panic when markets fall, overspending when income rises, the delay in investing because it's too early. Even I started working very early, but I also realized it a couple of years down the line because I was also learning on the job. Because we don't grow up with this kind of education system where money is taught at school or college. Nobody teaches us how to manage money, especially yeah, our days where there was no internet, no YouTube, nothing. All we heard was, okay, we have to save for our heydays, bad times. And options were limited, your fixed deposits or maybe gold or cash at home, how our mothers also saved. So that's when I realized that wealth is 20% strategy and 80% behavior. So when I was building Lovak Capital, so I strengthened this belief even more. That markets will keep changing, regulations will keep changing, economics change, but human emotions, we're always, you know, struggling, and we are not able to take decisions. Most of our decisions, especially around money, is impulsive. And managing emotion, especially investing, is where the true wealth, is decided. So wealth is not built by predicting markets. It is built by mastering yourself, especially your habits. And over the years, my biggest learning has been simple. Consistency and discipline beats any market cycle. Risk management matters more than chasing returns. So knowing your risk appetite, you know, we all are expecting, okay, we should make 18%, 20%, 50% returns. But are we ready to see the same drawdown losing 10, 20%? So that gap of understanding is there. And that's where we chip in, helping people understand their own risk appetite. So your mindset around money determines your trajectory. And trusting the time, trusting the uh, you know the system, the cycle is very important. Because if you see last 20 years, we've seen many ups and downs, market cycles. But if you had stayed invested, have did you ever lose money? No. People who have invested and stayed long in the market. So if I had to summarize my journey in one line, so wealth is built by small, consistent decisions taken calmly over a long term period.
Phenomenal. I think what you've just shared is like gold, I think for me, the biggest two powerful takeaways that you said, one is that wealth creation is all about emotional resilience, emotional discipline, emotional channelizing. So how do you really manage your emotional behavior? And how much are you ready to put in the commitment and put in the work of just staying there, you know? And I think the second point that you said was that staying consistent, like being very disciplined about it, and the risk appetite aspect that you talked about. And everybody has a very different way of looking at it. For example, someone may be very high risk prone and someone may not be. So those kind of things of course happen. But I think this
Yeah,
is
understanding yourself, what makes you, peaceful at night, how much risk at the end, we are all doing this for financial freedom, have a,
yes, yes, absolutely. Absolutely. And in fact, what I would like to say is that, contrary to our beliefs of how we've grown up and, how we've been conditioned to believe about wealth, is that it is to gather materialistic aspects. But what I feel is it gives you freedom of choice, it gives you freedom of time, and it gives you freedom to live the way you want your life. You don't have to
absolutely,
be
absolutely.
you don't have to follow any norm. You don't have to do it the way society expects out of you. You are absolutely free to make those choices once you're able to have wealth creation. And for me, that is the biggest benefit of this wonderful topic that we're talking about. So, coming to the second question now, since, like I was mentioning, we have a lot of young professionals who will be watching this live, and of course, student community who are watching this live, and they are all in the age group of 18 to 23 or 24. And that is usually a time when we don't really think about wealth creation so much, because we're very focused on our education. We are very focused on our careers. Of course, we are feeling a great high when we get our salaries for the first time. And, the first urge is to splurge it and, to buy something and do something and not really save, But is there an age to start this? I mean, is there a limit to that? Like, how young can people start? That's question number one. And since young professionals and students are watching this, what are the three most easy practical tips that you would like to share with them on how they can start? Jyoti, I hope you were able to hear me.
Yeah, so the right age to, yes, I got it. Am I audible now? Yeah.
Yes, yes.
So the right age to start investing is like as soon as, even when you start especially for children and young ones, as soon as you start getting your pocket money, I think as parents, we need to, make them aware of, how, I mean, importance of saving and investing both. So, I have a 16-year-old and I have a lot of her friends sometimes coming to me, Auntie, I want to, come and learn and start investing. So, uh, it's never too late or it's never too early. So I would say since we have students here in the chat today, so when you start early, even if it's your internship stipend, so starting early is more powerful than starting big. So if two people suppose invest, even 1,000 rupees per month, one starts at 22 and another starts at 32. So 10 years, 20 years down the line, who would, benefit more? The person who is starting at 22. And like you said, then you will have more power, financial freedom to take your decisions. Maybe you want to take a job break, maybe you want to travel, so this investing empowers you to take your own decisions. So the beautiful, concept that works here, we have always heard the power of compounding. And compounding rewards patience and your time in the market, not intensity. So even if you invest, 10,000, 10 lakhs today or 10 years down the line, the person who's starting early will always, be rewarded more by the markets or, by the investments.
Sure. So what you're saying is that even as early as 15, 16
Am I audible? Yeah.
Yes, you're audible. In between, there was some lag in the voice, but now you're fine. Now there is. It's okay. So what you're saying is that, students can start as young as even 15, 16 years of age, or when they start their first, job or their first internship. Even that is something that they can even start with. Ms. Bhandari, are you there? I think there is some technical issue at her end. We'll just wait for her to join. Yeah.
Yeah.
Can you
think there was some network issue. Yeah.
There was
Sorry
some.
about that. Yeah.
Yes. So coming back to the question, you said a very powerful thing. So there is no such age. In fact, from the moment they start getting money in any form, whether it is even pocket money or it is their first, trial job or, one of those first experiences where they start, just experiment with things and they go out and do something random, or their internship, or, these mini side jobs that students tend to do to have a good pocket money, they can start from just that stage, whatever that age could be. Is that right?
That's right. So I'd like to leave a question here for students. How would you feel tomorrow, 10 years down the line, if your bank balance is zero or you have a corpus that you have built over time? So your confidence, your stability, your, mental peace, options, your control on things you want to do. So it's not a luxury or status to, invest. It's a necessity. Because income can give you comfort, but assets give you freedom.
Right. Very important. So if I had to ask you some very simple tips that you can share with students today, of how they can start at a very preliminary stage, what would you advise to them?
So 3 simple steps that I can think of is like start tracking your money, where it goes, and differentiate between your needs and wants. So you need so you need to think about building an emergency fund. You should always have 6 months to 9 months of corpus always in your bank account. So start building on that. So second would be building that emergency fund. Start saving even 10, 15% or 20% of your salary from day one, and just think that your salary is only 80% of what you're getting, and then spend, enjoy, invest in your upskilling, whatever you have to do, but start investing some corpus every month. Third would be start small, but start, just start even 1,000 rupees per month through a SIP in a diversified mutual fund or an index fund. Have an investment account, trading account or a mutual fund account to start understanding the how investments work. It's really important.
Right.
The goal is not the amount. The goal is to build a habit.
Right, absolutely. And the first point, in fact, that you started off with was emotional resilience, discipline, and consistency, and behavioral aspect. I think
Yeah.
that was a very powerful point that you started off with. So it all starts with that, of course. So it's not the amount, it's not the time frame. In fact, it is the discipline to start putting in money, investing in, even if it is a very small amount, even if it is something insignificant, but it should just start.
Because
So
our needs and habits and wants, they keep expanding as what we are today at 2021 and when you are at 30. So you need to be prepared for that. So it's about preparing, planning for a 30-year-old of yourself.
right. There was a very famous article that had come out in New York Times, in fact, of a real life story of a janitor who used to sweep and clean floors and classrooms in a school in New York, in a public school in New York. And all he ever did was maintain the discipline and consistency of saving some money throughout his career. And finally, when he did retire from that job of a janitor, he came out with I think a huge sum of money. I don't remember the amount exactly in his bank balance, which he accumulated over a period of 40 years of his career. And of course, he came out as an old person, but there was just so much of wealth that he was able to create by that simple job
Yes.
of a janitor. So I think that example is a very powerful example. It doesn't matter what you're doing, it doesn't matter how much you're earning. It is the habit and the discipline which one needs to inculcate and the behavioral aspect. Now, again, you touched upon a very important aspect of investing. In today's time, information is everywhere around us. In fact, we are bombarded
You're
with
right.
information as far as stocks are concerned, investments are concerned, the kind of tools that we can invest in. But because of that over information, there is also a lot of confusion. And there is also a lot of question in terms of where should we start investing? What are the ABCs of investing? And how should we take our first few steps if we are a complete beginner and we have no idea about investing? We don't know about the tools of investment. Yes, ChatGPT is there and other things, but it cannot simplify things for us in terms of understanding what are the ways that we can invest, which are the markets or which are the kind of tools that we should, have to invest in. How would you guide students and young professionals to first start with investment, maybe in terms of tools or stocks or anything in particular that you'd like to tell them?
Sure. So great. Like I said, simplest ways to start investing through SIPs and mutual funds, because in early ages, like students and our first jobs, we are really hustling. With our jobs, we don't have much time to track the markets, and that's where beginners, lose money or panic because they expect quick profits and they don't have much knowledge and they're not able to track it. So being actively trading in the market it requires like a full-time your attention and energy. So keep your investment from a long-term mindset perspective, and start simple by opening a systematic investment plan, a mutual fund account, or a trading account. There also any of the leading firms, wealth management or stockbroking firm, and invest in to start. You can invest in as simple as an index fund, wherein you're investing in top companies of India. So you are investing in businesses. So I think that's a good way to start. And once you develop certain, it's great to, since we have all the information, and if you have time, I would suggest everyone to study, or even where you're invested in a simple mutual fund. So they come up with their monthly fact sheets or monthly outlook. You can start studying that, and I'm sure that will give a lot of confidence.
Right. So if I can just dig into this answer that you've just said a little bit more deeply, let's say a student has access to a portfolio of, let's say, 10 such SIP options that,
Right.
companies where they are really looking at. And they have very good, interest rate returns and stuff like that, and performance over the last 3 years, 4 years, 5 years. But when it comes to simplifying that decision making for them in terms of, in these 10 or 12, which one should I go for? What are the top 3 or top 2 or top 3, 4 points that they should look at before deciding, okay, this is the SIP or this is the company that I should really
So
invest
top 3 or 4, 5 things would be, look at the fund's track record, how long it has existed, read about the fund manager, and definitely read about the risk profile. Every fund will give their, risk profile. Would that suit mine or not? It is really important. So if you are a high risk taker, you can invest in a small cap fund for a longer term perspective. Don't expect quick returns. But if you want safety and, consistent, steady return, look at a large cap kind of a fund which are more diversified. And if you still want that, I should get some debt kind of a return, or FD kind of return, fixed returns. So mutual funds don't guarantee fixed return, but over the period, if you are invested in a nice balanced funds, where you also have an exposure to debt, so it will definitely give you a consistent return that and an alpha over your FDs. So couple of these pointers, and rest, if when you study more, then you can go through, technicals or understanding their PE and other financial ratios, etc., to, analyze and decide on the fund.
Right. So if I could summarize this a little bit in terms of what you said first look at the returns, of course, the interest rate return. The second is mid cap, small cap, depending on your own risk appetite and understanding how much of a risk are you able to take or not take. The third is their overall performance over a period of time. And the fourth interesting point that you said was, if possible, read a little bit about that fund and the fund manager who's managing it, so that you
And the
get
investing style, yeah. So like I said, chasing returns is not the idea. Idea is understanding the risk first, because return is the function of, risk and reward ratio. So it's very important to understand where I'm investing and how much drawdown I can see, So whether I just want pure equity, kind of portfolio, or I like to have a mix of equity and debt, where my capital preservation at, all times is very important.
right. And if I understand it correct, debts are more low interest rate kind of tools,
Yeah,
and
yeah,
and they have lesser.
yes.
Right. So now coming to a very important question, like we started off, in fact, with this, the mindset aspect. And, as students and young professionals, we really don't have the discipline even in our earlier years to really start doing this kind of a thing. But like you said, emotional resilience, discipline, and consistency is the main game changer as far as wealth creation investing is concerned. If I'm a student who's starting young and I'm doing these odd internships and small little things here and there, and I've accumulated a sum of money, let's say even just 10,000 rupees, um, how would you advise me to start going in terms of saving it right now, and more in terms of mindset shifts? So if you could just take this sum as an example and just tell us.
Yeah, again, going back to start, once you have set up your risk profile, find the fund that is good for you. I would suggest starting with a diversified fund, more on the large cap, either a fund or invest in a basket of stocks, which is probably, Nifty 50 or top 100 stocks that you can choose. And don't expect quick profits. And don't invest that money that, this 10,000 I might need 6 months down the line. Invest for long term. And unless you have the time and bandwidth to track markets and manage on your own, don't check your portfolio daily, Like over information also makes us, take impulsive decisions, and uh, again, churning your portfolio very quickly doesn't give you the best of results.
So let's say
So,
if, yeah, please
yeah,
go.
so one is that 10,000 you can, I mean, we're taking this example, you can invest regularly, or you can invest, every month, maybe 2,000 rupees 6 months down the line through SIP. And yeah, so just remember, it's not a lottery ticket. You're investing into companies, and you need to have patience, they will deliver returns. And yeah, and do discuss with your financial advisor.
Right. And contrary to what we've always believed in just keeping some money aside in our account for the rainy day in our savings account, and just putting it there and not really investing it. And that mentality that we've already always had, that let's just keep a lot of money in the account because I like the feeling of that money being there in the account as a safety, security feeling. You would suggest that we are able to go a little beyond that, challenge ourselves, and push ourselves to start even withdrawing a little sum of money from that amount and then putting it back into various kinds of investments.
Yeah. So asset allocation, as we say, it's really important. Like we spoke about emergency fund, so it's not a bad idea to keep some money. If you have 10,000, maybe 2,000 rupees, you want to keep it for emergency cash requirements. But for that, also, you don't have to really keep it in the bank fixed deposit. You can always invest in a a debt fund, like a liquid fund or short-term fund, which can yield you higher return than your savings. Of course, we need to be aware of the taxation part, but there are other options available where you can access to capital is available. And like I mentioned earlier, don't invest that money into long-term assets, which you might need soon. So that we need to have that discipline, or, sit down with your financial advisor and have your asset allocation plan before you start investing. Because a strong portfolio needs a solid asset allocation plan. How
Right.
much it should go in cash or alternatives like gold, or equities or direct stocks. So there are a whole gamut of investment opportunities which are available depending on different risk profiles, different time horizons. So we need to sit down and, really plan.
Right. We have a lot of attendees who are watching this. So I'm just going to remind them once again, if you have any questions for Jyoti, please feel free to type in your questions. This is a golden opportunity we have to have, her with us answering these wonderful questions, or, anything that you'd like to ask with respect to wealth creation, investments, savings, stocks, anything on those lines. So, Jyoti, coming to your journey once again, I'm sure that with, like you said, you've had 25 years plus years experience of working in the corporate, and then of course coming into this field. But if you had to advise your own 20-year self, 20-year-old self on what you could have done right and what are the things you could have worked on, what would those be?
So if I could speak to my 20-year-old self, like I said, I learned on the job. So I wish I had started earlier. And I mean, you'll never be ready, 100% ready. So don't wait to feel ready. And you don't need perfection. Just start. You need participation. Start small and learn while doing. And don't outsource your financial decisions completely, because you are the best judge of your, goals. So have, as a student, when you're starting your life career, so it's important to set down your goals. It could be a travel goal, it could be, any goal related to your family, situation. So have your goals defined and start investing early. Maybe you just want to save up something for your higher education. So,
Right. And you also talked about one very important and interesting point right in the beginning about tracking your expenses
yeah.
and then really putting them down every time. I think that is a great discipline that we all need to inculcate. In fact, it's not just
Yeah, with Blinkit and Zomato, so impulsive, ordering, shopping. So we need to track how much money is going where. Am I saving enough for my future goals? So, this is about shifting your purchase maybe for a week or 2 weeks, but don't miss on your discipline on investing.
right. And you also spoke about this point about differentiating between your wants and needs. So maybe it's a good idea to just sleep over about something that you're wanting to purchase
Absolutely.
and
Absolutely.
not make that impulsive decision, and then, of course, take a call whether you really need it or not.
Yeah, yeah.
Yeah. So,
Because
yeah.
eventually this money, corpus wealth in your account will give you a lot of freedom to make, even decisions on your wants later. But you need to have those funds, in your account first, or in your investment portfolio.
Right, right, absolutely. And I think if I could just summarize some of the things that you've talked about, it is very, very, very simple, but and of course very doable, but something that requires a lot of discipline and consistency. Like you said, it's all about behavioral aspect of training yourself mentally and becoming very consistent and disciplined about the habit of investing, saving, and really putting it into action every single day. I think it's almost like muscle building, when we go out to the gym and we start building our muscles, it's about building that muscle of investment and savings and having that mindset. I think this is what you're essentially telling every student and every youngster, that don't worry about where you're doing it, how you're going about it, which tool are you investing in for the beginning. Just start anywhere, just start small, but do start young. And I think that's a very big takeaway for our audience today.
Yeah,
Uh,
another thing one of my clients suggested a long time ago, like we've spoken about power of compounding. When we invest, your money grows. And if we don't save and we, overspend and, we borrow, getting into credit card debts or borrowing from here and there. So always keep in mind that also that clock of, interest also works round the clock, 20, even when you're sleeping. So your debt cycle will keep increasing. So, you have to really think from that perspective as well.
Yes, I think that's a very interesting point that you've raised because again, I was reading some survey on this that a lot of youngsters today have begun their own cycles of taking a lot of small mini loans,
Yeah, yeah.
and sometimes to, do travel, sometimes to buy something. And, it could be something even very insignificant, but for that, they end up taking a loan. And the repercussion of those loans are, of course, huge.
Huge. So it's better to save first, plan, have a goal, and then really enjoy instead of worrying about coming back and, worrying about the repayments. Yeah, I mean, loans are accessible today to even, salary, even at a younger age. You can take 3 months salary advance. There are a lot of interesting, options available, but I would suggest stay away from that and make a financial discipline of investing
Right.
for your goals. Yeah.
And loans are very easily available now. They're very, very easily
Yeah,
available.
even these, I mean, especially these mini loans, which are available on your salaries and on your credit cards.
Yes, indeed, indeed. And I think that is the trap that we all need to be very careful of when you say of that consistency and discipline. Of course, if there is an emergency of some sort, then that's a different matter. But you also talked about emergency fund. And I think that is something which a lot of people don't really give a lot of thought to. They're only concerned about managing things from month to month, end to end, kind of thing, and not really think about a very long-term perspective, such as an emergency fund.
Right, right.
Yeah. So I think that's about it. We are now, anyways, coming to the end of this session. This is a area, like I said, which is absolutely non-negotiable in terms of its significance and importance, no matter what age or background we are from, which sector we are coming from. And like I said, this is being watched today by a student community and young professionals. We're so profoundly happy and delighted to have you, and I'm very feeling grateful about the fact that what you shared today was not something very complex. It was all very simple. It was all very doable and something that all of us can start doing
Yeah,
like from today.
and if you keep it simple, then you'll really go long. So don't get into complexities. Start investing small and consistently, and simple products, mutual funds, Nifty 50 index funds. It's really simple to start, and it can really take care of your financial future and financial freedom, especially for women out here. I would like to say it is not even an option, it's a responsibility. Since we are in the Women's Day week, so I would leave that note for girls and women students here that take your own investment decisions beyond beyond FDs and gold or cash. Learn about financial investing into markets, be it simple mutual funds or stock markets. It's not very complicated, but what it will bring to you on your table is your freedom to make even smallest decisions in your life, and ability to say no, power to say no.
That's a very, very important point, extremely important. In fact, we end up making a lot of choices and decisions because of financial pressures. And that leads to a lot of long-term implications for us in many ways. I think that
Yeah.
was a very, very profound point that you mentioned.
Especially for working women, if you have that financial security in your head, then you can freely ask for the promotion, raise, or a next leadership role, the seat at the table. So don't wait to be invited. Have your financial uh, plan intact and step forward, because financial independence, it's not given, it's planned, and it's taken. It has to be in our control.
Right, right, absolutely. And in fact, this piece of advice that you're sharing is also true for housewives who are not the earning members of their family and are dependent on their spouses or maybe some other member for that financial aspect. And I think it's a big takeaway even for them, because they tend to feel that they are powerless or they do not have control over decisions simply because they do not have the financial contribution to be, that they're making to the family. So I think what you're sharing is very, very relevant to every sect of our women community. And thank you so much. I mean, this has been a wonderful session. We can, of
I'm
course,
glad, and I surely enjoyed it. So yeah.
yes, and we can, of course, continue this discussion as part 2 of our series also later. I'm sure we'll be
Absolutely,
having
I'd
a
love
lot of
to.
requests from our attendees. And I'm really very thankful and grateful to you, Jyoti, for
Pleasure to be
coming
here.
and, enlightening us with very simple, doable things and giving us the confidence that this is very much doable, very much possible. I'd like to share that, when I met Jyoti for the first time, she was sharing in how in this male dominated world of investments in stocks, when she would enter a room which was related to such kind of financial discussions. She would be the only female, in that
Yeah,
room, and
those
how
were the days.
daunting.
Yeah.
Yes, and
Even
how
I was asked to sometimes, step out that, can we just go out for 10 minutes? We want to have a, only male discussion. And I would just put my foot down. No, well, you say whatever you have to say. And touch would, like, if you have that, like, it's confident, if you are asking for it, people also come around to support you. I've had the privilege of having good bosses who supported me. And I am here today because of them, because they helped me grow. So,
Right, but it was also your own determination and confidence, I think, which was able to pull you through out of these situations. And I think this is a big thing that I wanted to end this session with, to whoever is listening, that we don't have to feel daunted, we don't have to feel overwhelmed by what people are saying or doing or how they may be limiting us. We need to have our own stand. And I think, Jyoti, you are a great inspiration to us. For me personally, I am very bad at numbers and the whole art of investing. But I'm seriously very inspired by your
thank you.
words
Thank you.
today and by
Another,
your journey.
yeah, another point which comes to mind is when I always walked out of my house, starting my day, I never thought if I'm that's how I was raised also, probably, that I'm not a man or a woman. I'm there to do my job and I have to do it right. And, you know, so that will define my role and my responsibility.
Absolutely. We talked about mind shift today, and
Yeah,
I think
yeah,
this is a very powerful mind shift tool that you're telling to everyone, that don't really labelize yourself and
absolutely.
really go and do your work as it is.
So yeah,
Uh,
every day should be a Women's Day.
Every day should be a Women's Day. Thank you for this parting note. Wonderful. Neha, over to you for a closing note and thanks.
Yeah, this was a very fruitful and enriching discussion. On behalf of the GHRDC team, I would like to express my appreciation and gratitude to all the participants for taking out time to attend the webinar, and a very sincere thanks to our expert, Ms. Jyoti Bhandari. Your presence has been invaluable and undoubtedly has made this webinar a great success. Thank you so much once
Thank you for
again.
having me.
Thank you, Jyoti. Wonderful to have you. And I'm sure we'll have this association and continuation of questions again and
Absolutely.
again with you.
Anytime. Yeah. I'd love to be back here. Thank
Thank
you.
you. Thanks a lot.
Thank you.
Thank
All
you.
the
Thank
very
you.
best. Thank you.